You see those pro traders who seem to get it right almost every time and have a win rate through the roof? Well, their strategy isn't built on luck or some secret magic. They've mastered the art of reading the market's silent language, which we call price action. Today, I'm going to unveil one of the most powerful and overlooked price action trading strategies that they use quietly. This strategy works for scalping and swing trading across Forex, stocks, and crypto. By the end of this video, you'll know exactly when to enter a high probability trade using what we call the price action leading signal. Before we dive deep, here's a key insight. This strategy works across all markets, Forex, stocks, crypto, because price action remains consistent across assets. The price action strategy, a quick breakdown. The price tells us about the market sentiment. Each candlestick holds clues about the market's momentum, volatility, and potential reversals. But many traders miss the subtle details hidden within each candle. Without understanding these details, traders often enter trades blindly, hoping for the best but usually facing unexpected losses. The hidden power of candlestick patterns. By observing the opening, closing, highs, and lows of candlesticks, we gain insight into the underlying market forces driving price movement. This knowledge enables us to identify high probability trading setups, allowing us to trade with the momentum of the market instead of against it. Why price action strategies work? Price action strategies work because they are rooted in the belief that history tends to repeat itself in financial markets. By learning to recognize recurring price patterns, traders can anticipate future market behavior and capitalize on upcoming opportunities. It's a systematic approach that helps to cut through the noise of random price fluctuations and focus on the meaningful trends and patterns that drive long-term success. How does price action work? This strategy involves 1. Observing current price action. 2. Identifying patterns that indicate future movement. 3. Making informed trading decisions based on these insights. For example, if the market is in an uptrend and suddenly starts forming bearish price action patterns, it could signal a potential reversal, allowing traders to prepare accordingly. The heart of price action strategy, the leading price action signal. Price action reveals valuable information about the market's inherent strength and direction. The key is learning to read the subtle cues within each price bar. But here's the problem. Traditional price action analysis can be complex and overwhelming for beginners. But here's the secret. By focusing on a single leading price action signal, we simplify the process and make it easier to apply. The double bottom pattern. Let's start with a simple yet powerful pattern, the double bottom. Here's how it works. The double bottom pattern is a bullish reversal pattern that appears in the shape of two low points that touch the same horizontal level. When this pattern forms after a downtrend, it suggests a potential reversal towards the upside. The RSI provides extra context for this pattern. When the RSI is below the 50 line and making higher highs, it supports the likelihood of a bullish reversal, the head and shoulders pattern. Next, let's examine the head and shoulders pattern, a versatile pattern that can signal both bullish and bearish reversals. Here's what you need to know. The head and shoulders pattern consists of 3 peaks or valleys. The middle peak or valley is the highest or lowest, and the outer ones are lower or higher. If the market is in an uptrend and a head and shoulders pattern emerges with a neckline connecting the outer peaks or valleys, it may signal a potential trend reversal. In this case, the RSI breaking through the neckline in the opposite direction can further confirm the reversal. The power of price action, price action trading, allows us to respond dynamically to the changing nature of the market. Instead of sticking to rigid rules-based strategies, we can adapt our approach based on real-time price signals. This flexibility helps to navigate the unpredictability of the market and seize opportunities as they arise. The edge of this strategy. Compared to traditional strategies, the price action leading signal offers several advantages. 1. Simplicity. It focuses on one signal, making analysis less overwhelming. 2. Versatility. It can be applied to various markets and timeframes. 3. Accuracy. It uses multiple confirmations, reducing false signals. 4. Dynamic adaptation. It allows adjustments based on changing market conditions. This strategy isn't just about following the crowd. It's about becoming part of the crowd that influences market trends. It gives you a competitive edge, helping you make smarter, more profitable decisions. Why price action signals work. The price action signal works because it reflects a shift in market momentum. Price action is a leading indicator, reacting to subtle changes in market dynamics before they are reflected in the price. This makes it possible to identify potential reversals or continuations before they become obvious. Practical example, bullish setup. The price is trending upwards. Notice the consecutive higher highs and higher lows indicating an uptrend. At a certain point, the trend starts to slow down and a double bottom pattern emerges connecting 2 points of support. The RSI also shows a similar pattern, suggesting a potential reversal. The price action leading signal suggests entering a short position. Stop loss can be placed near the neckline of the double bottom pattern. As the price falls back into the trend, it creates a large lower wick, forming a bearish candle. The bearish candle serves as an additional signal of a potential reversal, suggesting a short opportunity. 1. Double bottom pattern. 2. Falling RSI 3, bearish candle with long lower wick. 4. Entry signal for a short trade. 5. Stop loss near the double bottom neckline. Result: a successful short trade capturing the market reversal. Practical example, bearish setup. Now imagine the market is in a downtrend. You would look for bearish patterns such as a head and shoulders pattern. A head and shoulders pattern with a neckline connecting the outer peaks or valleys may appear. At this point, the RSI breaks through the neckline in the upward direction, providing additional confirmation of a potential reversal. The price action leading signal suggests entering a long position. Stop loss can be placed below the neckline of the head and shoulders pattern. As the price rises, it breaks through the resistance level indicated by the neckline, creating a bullish candle with a long upper wick. The bullish candle serves as an additional signal of a potential reversal, suggesting a long opportunity. Wow, handelssion holds snarty one. Head and shoulders pattern. Rising RSI 3, bullish candle with long upper wick. 4. Entry signal for a long trade. 5. Stop loss below the head and shoulders neckline. Result: a successful long trade capturing the market reversal. Why our strategy outperforms random trading. It's not just about using the price action leading signal. It's about implementing it strategically. First, our approach eliminates random trading by focusing on specific patterns that indicate potential reversals or continuations. Second, we increase accuracy by using multiple confirmations, reducing false signals. Third, we incorporate the RSI for an extra layer of confirmation. Fourth, we have proper stop loss placements based on key levels in the chart, helping to manage risks. Finally, we test on multiple time frames to find the best entry. So it's not just about relying on a single signal, it's about integrating it into a robust trading strategy. You might be thinking, great strategy, but how do I implement it in my trading? Well, here's